All right. Hey, what's up, everyone? Welcome to a special America 250 edition of Ask Me Anything with the Money Multiplier BYOB Money Mentor team. We are here today to answer any questions you have around infinite banking, around financial strategies, different types of investments, real estate, annuities. What do you guys want to talk about? What are you hearing in the news? What are you hearing from your advisor? What are you reading about? What's good? What are these high yield savings accounts doing? CDs? What does all this stuff mean? I don't know. What is infinite banking? We're here to answer those questions and more. You can see we are festive today, ready for the 4th of July, ready for that 250-year celebration, and ready for some U.S. World Cup soccer tonight. So hopefully all of you are as well. Grab a drink, grab a coffee, grab a water. It's Wednesday. I don't know. We'll call it hump day. So grab whatever. Get your questions over in the chat box. We'll answer all of those. Be right back in about 14 seconds to get rolling. All right. We are rocking and rolling. Welcome to Ask Me Anything. This is the weekly show we do where we can answer all of your questions put on by the BYOB Money Mentor team. So we appreciate you being here. Get your comments over in the chat box, and we will start answering those. Before we do that, we'll do a quick little around the horn. My name's Stephen Nagy. I like to call myself the ringleader of this circus, or this financial team, as we prefer to be known as. Miss Tess has her kitty cat going over there. Brian Fouts is playing with spiders. Jason is limping around on his broken hips. And Linus is being the man like he always is. But I'll let you guys do your own introduction. So what's going on, Mr. Brain Foods? How are you today?
What's going on, everybody? Brian Fouts here up in North Idaho. We're finally starting to see some warm weather. It's gotten really cold. It was actually 50 degrees the other day, which I don't like being up here. But, starting to get out into the summertime. Unfortunately, though, my daughter, my oldest one, is going to summer school. So every day I got to drop her off really early and pick her up every day. It's almost 25 minutes away. And so, our summers are going to be a little different because one of us is still going to school and it doesn't really seem like summer yet. But other than that, just kind of getting rolling and looking forward to doing some fun things with the family here. But over to Tess.
I'm Tess Hulek. I'm grateful to be here. Insurance has been my life since the day I started working, so I love being here and I love learning a new way than the corporate four walls. And I'm going to age myself. Stephen was talking about Hump Day. You all know about Taco Tuesday. Long before Taco Tuesday, we had Spaghetti Wednesday.
Spaghetti Wednesday?
Echoing.
That's new.
Linus.
Hey everyone, Linus Nolt here from Hopkinsville, Kentucky. Got my first Hawaiian shirt. Here it is, and it's an American shirt. If you see on the side, it says 1776 to 2026. Oh yeah, 250 years. We're having some hot days over here in Kentucky. People are doing the farm work, hay is being made, but it is hot out there.
Send some my way.
Right?
Yeah.
You just need to move further south, Brian.
I've lived in the South. I lived in Louisiana before. I get it.
Okay. Yeah, you know about humidity then if you've been in Louisiana.
Yeah, and where I was in Louisiana was North Louisiana, which is worse.
Yeah.
So Monroe, Louisiana, everybody knows where that's at. Remember when I first got there the first time, my dad and I were driving for like 6 hours. Hadn't got out of the car. We get to Louisiana. We open the door. We're like, holy crap. And this was like, I don't know, early September or like August, which is the worst. Oh my gosh, I loved it down there though. I loved it, but my wife did not. She was pregnant too, by the way. So
yeah, it can be rough. I'm over here with my water today, staying hydrated. Jason, no, what you got?
Yeah, I'm here. What's up? Happy Wednesday, all. Let's get this rocking. Bring your questions. I'm not seeing a lot of questions in the chat yet. USA soccer tonight. Last night had half my heart break because my wife's Ecuadorian, so I was rocking the Ecuador jersey, and Mexico went to town on them. Stephen, it was ugly. It was not a great outcome, but next time, next World Cup, 4 more years, and we'll be back. So
I haven't not even watched one game. I don't even know who's winning, who's not, nothing.
Senegal is winning right now, 1-0. So there you go.
The
That's your
US?
update. No, they're beating. Who are they playing? I was just downstairs looking at my dinner, hungry. I forget. I'll check.
What was the question?
Who is Senegal beating right now?
Oh, Belgium.
Belgium. There you go.
Jason, it's like 4:40. How can you have dinner?
Well, once you're over 50, man, you're allowed to eat whenever you want. Early bird.
That's crazy.
Yeah, he's leaving us already. Okay.
Yeah, he's got to go do something. Apparently. Well, we got this one question here. Valentino says, "What's the catch?" Now, I like bass, preferably, or crawfish. I do a lot of
We're
crawfish
gonna have
up here.
fun on this Wednesday. I like it, Fouts. I like it.
Yep.
What
I
else?
do a lot of crawfishing. That's my main thing. But anyways, if you're referring to infinite banking, which I'm assuming Valentino that's referring to, if not, just clarify in the chat box there. What's the catch? Anybody want to? I mean, I've had this question many times. Anybody want to fathom an answer?
I actually want to say that the catch is you're going to have to do a little bit of learning in order to put it into play. So I don't think of it as a catch since I've been around it so long. I think it's a tool I wish I had known about a lot sooner.
Here's my response. I like to give to this one. Most people, as we go through life and are learning about money and finances and investing, we're being influenced by other people. And to the point where, let's just assume that your financial life is a bus and you hop on that bus and where do you go? You go in the back seat and then somebody else is in the driver's seat. They're the ones driving your financial life and you don't even know where they're going. You don't control where you're going. You have a general idea maybe. The catch with infinite banking is when you hop on that financial bus that is infinite banking, you're the one in the driver's seat. You've got to know how to drive the bus. You got to know where you're going. You've got to learn how to do that. So that's my big thing right there is that you have to be in the driver's seat and not just like forget about it and then hope someone else will do it for you. So that's my one big catch there. You also do have to qualify. I mean, that's another big one is you have to qualify for a policy and not everybody. In fact, the majority of the population cannot qualify for life insurance, which is kind of scary. So it's I always say it's a privilege, not, it's to be able to do this. It's not a right. It's a privilege.
There's so many things going on in my mind. I don't even know what to say about this one. Let's see. Remember, I'll date myself, Tess. If you like Seinfeld, you remember the episode that George does everything the opposite?
Oh, yeah.
And all of a sudden, he's got a great job with the Yankees, and everyone loves him. And he's got a beautiful, tall blonde that's like a foot taller than him. And people are waiting on him and serving him, and life is so good. Well, when he went against his opposite instinct, kind of like Brian's story, when he started asking different questions and executing differently, life started to change. So as long as you can qualify, as long as you're willing to think differently and do something that's been around longer than the current financial system has been around, then we can help you.
Yeah. Whenever that episode, I always think about in the conference room where he tells a joke and everybody laughs and he goes, "I'm out," and he just leaves right away.
Exactly.
Instead of staying and telling the second joke that nobody laughs.
Yeah, my buddy still does that to this day. He still throws up his hand, does that. "I'm out." When something goes well, he's funny, whatever. He does that joke still to this day. And until you said it, Brian, I didn't even realize that's what he was doing because I'm terrible with remembering different quotes and lines from movies and things. So
Exactly.
So the catch is you've got to be willing to challenge what you already think you know.
Yep. But if anybody's on here, go ahead and get those questions in the chat box. Otherwise, this is going to be a short Ask Me Anything. I do have some other questions over here that we will go ahead and go through those as well. Someone's asking, I don't know how to access the other program to watch your weekly videos. Yeah, so Stephen, did you want to give a kind of a rundown of the weekly live things we do, and I'll get some other questions going?
Yeah, I mean, I can put the link in. We have a real simple just link tree that can take you to everything. I'll put it over in the chat box. It's linktr.ee/BYOB TV. And so we do 6 different live shows each week, which would include a Money Club Monday on Mondays at 1 p.m. Eastern, which are Private Money Club Premier members, primarily borrowers. So people that have real estate opportunities and deals that are looking for private money, they come on and present the deals and talk about them and build relationships with lenders. So if you're interested in real estate investing and specifically private money lending, it's a great place to be each Monday. at 1 o'clock each Tuesday. Brian and Jason and the team here do what's called Take Back Control Tuesdays, which is basically the 60-minute full infinite banking training presentation. So, what exactly is infinite banking, from mindset to case studies to examples to how it actually looks in your life, like how it solves various money problems. So we do that every Tuesday at 1 p.m. Eastern. On Wednesdays, we do What the F Happened at 9:30 a.m. Wealth webinar, which is full of different financial strategies and topics each week. It's different and new content. We do that on Wednesdays at 1 p.m. And then this show, of course, at 4:30 each Wednesday. And then on Thursdays, we have the Private Money Club Quick Start webinar, which is real estate investing and private lending education. And those are all free webinars and trainings that we do each week. So you can watch those either by registering for the Zoom, and it's the same Zoom each week. You can hop on, even though it's new and live and different every week. It's the same Zoom. Or with this show and What the F on Wednesdays, it's just a live stream on our Facebook channels and YouTube, sometimes Instagram. So those are our regular shows. And then, we do one-off trainings. So we do a cracking the vault code every other Tuesday evening, which is how to use the BYOB vault, and discussions around, using infinite banking with the vault. We do different shows throughout the months, just kind of on specific topics. And you should receive emails. If you register for any of our weekly shows, you should start getting emails on any of those one-off events as well. So, and none of that's to mention, the YouTube content that's put out almost every single day on at the Chris Noggle YouTube channel. So definitely subscribe to that, and you can follow along. So lots of education. It's all free and it's all super valuable. So check it out.
There you go.
WTF is a really good one because Stephen and St. James like to duke it out from time to time. So it's a lot of fun.
Oh, yeah. And then the Founding Fathers, Jason, that's at 3 every Thursday too. So
3 every Thursday.
Lots of shows.
Yep. All right. So a question we got here earlier today was, I'm getting ready to start my first policy here soon. This person has not done their mentor call yet, strategy call yet. They said, what should I do to prepare for going through the process? And we're all going to have a good answer. And here's my answer to that one. Get your financial life in order. What I mean by that is most people don't really understand where their money is coming from or where it's going, especially where it's going. And so our vault software for a lot of people is they kind of open their eyes to saying, oh my gosh, I didn't realize I had so much money going out the door. So Craig actually on one of our prior presentations today said, hey, we recommend using these softwares to really help you get a better grasp on your money. So Quicken, which is what I use, by the way, or it's a version of Quicken for personal use, Rocket Money, or Monarch. So if you're getting ready to start a policy, one of the best things that can really help you and answer the questions we're going to ask you is knowing those, where your money's going, where it's going, and knowing all that kind of stuff. So that would be my answer to that one. So once again, the question is I'm getting ready to go through the infinite banking process to get a policy. What should I do to prepare? So who wants to go next? Jason, I know you got an answer.
Yeah, of course. Yeah, of course I do, man. I like your answer. Your answer is get closer to your money. Know what's coming in, going out, what you're paying, what interest you're paying. Have an idea. I think the 3 main things are know how much you're saving, where you're saving it, and be ready to talk about where you're saving your money. B would be have an idea of what you want to accomplish. There's usually 4 things people are looking to accomplish. It's either eliminating debt rapidly, making some kind of major purchase, putting their money to work in an investment or legacy. And you might think in your head immediately, I want all those things. Very cool, but pick one. Because the clearer you are in your conversation with us, the better we can build. Like today, easy conversation. Woman came in, she's like, hey, I have received this inheritance. I have $15,000. My daughter is having a kind of a needs a loan, and I didn't just want to give her $7,000. So I want to put 15 in. I want 7,000 out. I want to have legacy. I want to be able to put more money in it. I'm like, that is super easy. You just told me exactly what you want. I know where to go. I know how to engineer it for you. If you come with specific idea of what you're trying to accomplish, we can help you accomplish it. So,
yeah.
I think I'll go next. What I was going to say is to know what problem we're going to solve, but Jason kind of covered that. So what I'll say is for most, if you watch that video, And we call it the 90-minute, but Linus and I were talking. It's only 78 minutes. Watch the video and write down questions. Then you come to the table already kind of preliminarily understanding the process so we can help you do it.
Yep.
And I like, if Linus has got something to add, I like Matt's answer. I know we're not there yet, but the catch, learning to bank, learning to take a loan from yourself, but most importantly, paying yourself back. So just learning the system, like doing the thing. Linus, what do you got, man? That's a rocking shirt, by the way. Patty doesn't let me rock my, well, she doesn't mind if I wear Hawaiian shirts. I used to wear one every Friday, but when she looks at me and tells me, makes a little, looks funny at me, I just decide like, it's not worth the battle. I want to look good in her eyes. So I stopped wearing them.
It's the first Hawaiian shirt I've ever put on. I only got it, 2 weeks ago and put it on the first time 6 days ago. So this is a new thing for me. Thanks. So all very good answers. I was just going to add, look into getting the book, Becoming Your Own Banker by R. Nelson Nash. So this is really the original book and guide for the infinite banking concept. Read that, read it multiple times. That's a big foundational piece too.
Yep. All right. Another question we get over here is from someone, and this is a kind of a broad question. And they said, how does infinite banking help me to prepare for retirement or provide income in retirement? Well, there's quite a few answers to that one. I'll give one here real quick. It depends on your age, how much you're putting in, and it also depends upon what current resources you have already in place for retirement. Because infinite banking is not a silver bullet for retirement. And by the way, it's typically only maybe a supplemental retirement strategy. But in reality, life insurance is not geared toward retirement income. It's geared more toward protecting your household from a loss of income. And then other types of vehicles can provide guaranteed income in retirement, which are things like annuities, Social Security, other investments, all that kind of stuff. But it really depends upon your overall financial picture. So that's kind of my answer to that one.
I kind of liked the way it was explained in some of the retirement training that I've been going, and that the whole life is about the big purchases as you get into retirement. And the annuity train is about covering your fixed cost every single month. So the two together can help you. And I love that, like Brian said, the whole life will cover if you die too young. The annuity will cover living too long.
And guess what the biggest risk is?
Living too long.
That's the biggest risk for most people, especially in retirement, which is a weird thing to say. But here's the fun thing. There's a stat out there, statistic, that those who have guaranteed income in retirement live 20% longer than those who don't.
Yeah.
That is stress and worry, which is just beat your body down. And so that's why I'm a big advocate of the guaranteed income side of things. I wish I'd known about this years ago, but I learned this stuff like a lot of people late in life. So.
All good answers. I think we're really solving for stress and worry.
Yes.
That is what we're solving for Americans. We're solving for stress and worry. I guess the other answer I would give on that is if you go do your research, like this isn't a one size fits all, like Brian said, depends. There's different strategies depending on what your comfort zone is, what you're trying to do. But as far as like, if you go and research this, you can look up, Ernst Young has an article that says, Americans should have whole life as 10 to 30% of their assets. Well, why? Because it's guaranteed. It's protecting the family. It's something you control. So whether you're using it for the supplement income, whether you're using it to invest and create more income, whether you're using it for purchases, it's just another asset that you control where you don't have to worry. Like there's no stress as long as you're able to make your premium deposits and you're consistent and persistent, and you make it a focus of paying yourself first, kind of following the laws of wealth, then this just reduces some of that stress. It's just like, I used it recently. I know Steven was joking about my hip, but I just used it to pay for a total hip replacement because I had been putting my premiums in, the money sitting there. I was able to go ahead and use that as a loan versus being stressed about how am I going to come up with the money? I have to finance this. I have to go out. It's being proactive in your life. Having this as a storage unit for urgencies, emergencies, and opportunities is a good thing to do. And I see that Linus is leaning in and has something to say too. So jump in.
I actually didn't. I think you read me wrong, man, this time.
Oh, good.
Usually you got it.
Yes.
Hey guys, I got to jump on to another meeting here. I just want to say hello to everybody and happy 4th of July. You know, you guys can finish answering the questions. Somebody's asking about Joe Kovacevic. Joe has decided to focus on his family, and he's taking some time off from working with the BYOB family and what we're doing. And so we are making sure to take great care. So if you've worked with Joe or anything, need anything, just reach out to myself. We're here to help, and we're going to let Joe focus on his family and what he needs to handle personally.
Yep.
Love Joe, though. Great guy.
Yep.
Cool. All right, I'll let you guys take it from here. Thanks, guys. Happy 4th.
Take care, Snaggy.
All right, Mr. Matt, good question here. It says, so I have mine set up for a little bit, half a year now, and he's referring to infinite banking, by the way. How should I watch for learning how to set up to pass to my kids? Thank you. I mean, obviously, Chris has a lot of stuff in the YouTube channel on the generational wealth strategy, but how a lot of people do this if they're trying to pass it on to their kids, there's a couple different ways. One, they can just be the beneficiary. That's pretty straightforward. Anybody else want to get into the other ways you can pass it on to their kids in a more strategic way?
Yeah, I can share a lot on this. I mean, I could talk for the rest of our 33 minutes we have left on this, Matt. So feel free to reach out to me. I put my email under my name, just jason@beyourownbanker.com. But this is something that keeps me up at night is how do you pass this on? Even today, Patty and I were having our meeting around our generational positioning system. It's kind of like the vault, but for your mindset, for building your constitution and things. So depending if you're talking about how do I pass this on legally, like Brian said, you make the beneficiary a trust perhaps, and then you have rules in place like dynasty language in that trust that tells your kids how you can do it. If you're looking at how to get your kids involved in this, it's really just starting to talk to them about being your own bank, talk to them about how much stuff costs. And like I said, reach out. It's communication. All I can tell you is it's like your money. The more you're communicating with your kids, they might not seem interested, but they are listening. And then you put the systems and processes, you might have different points. Like 12 years old, you might have them learn and do something specific with money. 18, like you might have different kind of coming of age moments where they get new responsibilities in your banking system as well. So,
yeah. And then,
how do you all handle it? Sorry, Brian, but how do you guys all handle it? Do you talk? I mean, you have kids, right? Linus, Brian. So how do you handle talking to your family members, talking to your kids? Like, how do you guys do it?
Depends on if they're open to it. That's the biggest one. So like, I don't talk to it outside of my wife, and my brother knows about it, and he's always been, and he's a few years older than me. He's always said, I should do this. Like, yeah, I believe you should too. Never has, and probably never will. And he has a spouse that is not into anything alternative. It's partly why, but I don't really talk about it outside of my wife, really, to be honest.
Do you talk to your daughter about it? Do you talk to your?
I do. They're really just not, their mindsets are not there yet. But how we help a lot of clients do this, because obviously over time, your policies are going to grow to be a very large death benefit potentially. And money can be very powerful, negatively and positively. We all probably know stories of money ripping families apart. And that is one of the things, a fear that I do have. And so how do I help prevent that? That's a trust. So a trust can help structure how the funds are received and then handled after the fact, after I'm not here anymore. Rather than just giving my kids $500,000 each or something like that, which they might just go to Vegas and blow it, the trust can actually have a plan built inside of it where I say, hey, I want to have a portion go to them, a portion go to creating more policies for my kids and grandkids. And the trust then has to take care of that. So it takes a lot of foresight and thought to do that, which I know, Jason, you're very into that kind of stuff. You have to think about that ahead of time. And your trust can be structured that way. So we have partners that do the trust for our clients, and these partners know how infinite banking works, but that's one way to do it. And I've had clients that have very large policies, and And they realize, oh crap, if my kids get $1 million or something, that could really cause a problem in the family. Because keep this in mind, their kids now have $1 million each, but the rest of the family is still average or struggling. And so it can create, conflict. So that's kind of my answer to that one. But very good question, though. Very good question. I don't know, Linus, you have anything?
My 4 kids are 6 and under. They certainly know we all have policies, and I work a lot with policies. And I don't think I've even necessarily told them what the policies do as far as death benefit. I'm always talking about them as a store of money, and that's where you get money to use to finance things. So that is actually kind of a new thing I'm just thinking about is, wait a minute. Yeah, I haven't really talked to them about death benefit. What the policy is truly for in the future ultimately. But a smaller scale, simple way maybe to keep that from just being a big lump sum to the beneficiaries could be, generally an insurance company can allow you to set up a required way or a specified way to pay that out. Maybe there's a small lump sum to cover funeral expenses and other final expenses, and then for the rest of it to be paid out to the beneficiaries as a consistent income. So that's an option. And so in some cases that might be the easier, a small scale way to do it. Because the trust starts getting a little more complex. There's more cost that goes into it. There's a lot more you can do with it, a lot more parameters you can set up. But just from a simple perspective, that could be a place to start too. And that's something I'm looking at doing.
Yeah, it's a really good point, Linus. You can kind of get as complicated or as simple as you want with this. It's how much do you want to control? Like I started really worrying about this because I wasn't focused on death benefit and stuff when I started. Like it was to stop the bleeding. It was stop the interest that was leaving my family. But then once I had, now I have $3.5 million of death benefit, somewhere around there on my body now, which is significantly more than anyone in my family's ever had. I know that for a fact. And I started worrying like, how do I not create entitled kids? How do I not have them thinking, hey, we're going to get this big payout someday? Okay, we're going to start talking about, we're going to put systems and processes in place. Someone mentioned, we're going to make sure that if we take a loan, we pay it back. And if it's not paid back, well, guess what? You don't get to take another loan, right? For the things that you might leave. So you start putting the stipulations, you start putting the systems and processes in place. And it really makes you think through a lot. Like I'm years into this. Build a SaaS program for this, a platform for exactly what we're talking about to help families talk about it and organize it and keep, like Connor calls it, an online digital drawer for all these type of things. But at the same time, it's an ongoing learning experience, and it'll force you to be a better leader at home. It'll force you to be more open to your family, to communicate about where they are with money. It's no different than meeting any one of you on the call. Is you really got to understand where your kids, your family, your wife, whoever is with money, so you can start having the conversation with them. It forces you to really to be not only present, but to be open to things that might not fit with how you saw or thought it was going to go, because it most likely won't go how you think it's going to go.
Yeah, for sure.
And I'm gonna speak to it from a little bit different perspective, because there are those out there that do not have children, and I'm one of those that does not have children. So what is my approach? My approach is that I have 3 godchildren, and the way I did it, because it's important to me that this message continues forward past my life, I told them that I will adjust the percentages that go to them based on who learns this process. And so far, only one is on board, but that's okay. At least then I know my message moves forward, because ultimately, it is as Chris says, my goal. So I want to know that it'll move forward into future generations.
Yeah, love that. Love it. And Craig says, I turned in late, but wanted to ask this exact question after what Brian said in webinar. Thanks. What was the question? Which one was it?
I don't know. And for the presentation, can you put the link to the calendar for the call? Because doesn't that have the presentation in it as well that they're looking for, right?
It does eventually. Yeah, I'm going to put it here in a moment. Yeah, I'll put it in there.
Yeah, I did send the 90-minute, the 78-minute to you and Linus. I should have added Jason too. I just can't put it in the chat myself.
Yeah, I think that's what they were referring to. So I put the link in there, so that YouTube video right there, you can go check that one out. There's a lot of versions of it we have, but probably a couple dozen different versions of that same 90-minute presentation.
And this one's only 78 minutes, so you save a few.
My last one was a 1 hour, 1 minute. So, all right, another question we got here today that I want to address here. This is kind of a good one. So someone says, I have an IRA. They didn't say how much, by the way, but said, I have an IRA. Does it make sense to take it out and put it into infinite banking policy? This person, by the way, is not 59 and a half yet. They're in their mid to early 50s, I believe. So that's a great question, and it comes up almost every single week. So anybody want to answer that one? It depends question, of course.
One strategy that can be a fit that's kind of awesome is potentially to roll over that qualified IRA, right? It's not a self-directed. Wait, was it?
Doesn't matter if it is or not.
Okay. Yeah. Roll it over into an annuity that is an immediate paying out annuity that pays out for, say, over a 10-year period, and have that payout immediate funding a policy over the next 10 years. That can be a great way to break up the taxes and penalties if you are inclined actually to take on the taxes and penalties. But there's so much more to look at. It's just kind of a surface level thing there.
And the answer that I get to that one is it depends on what they're trying to solve. Is it for income? Is it for liquidity? What are we trying to solve here? Because if you move it into an infinite banking policy and you have liquidity now, what are you going to do with that liquidity? Are you going to go create more cash flow and more wealth in your life? What are you trying to accomplish? Because the other option is if you're no, it's more about, hey, I want to have more income. If that's the ultimate goal there, not really liquidity, then I would probably do a deferred annuity so that you get past the 59 and a half point. And so that annuity can grow for guaranteed for, well, call it 10 years, but you can turn the income on any time. But if you do it after 59 and a half, there's no more 10% penalty. So once again, it depends on what you're trying to accomplish with that qualified fund. And then there was a lot of questions on the presentation here today on that kind of stuff. And a lot of it was around risk. So if your portfolio for retirement is all in 401ks, bonds, treasuries, mutual funds, et cetera, even real estate, by the way, that's all the at-risk bucket. Everything's at risk. And that's a lot of people are really over the skis, I call it, or upside down because they have so much at risk in their retirement portfolio. If something changes in the market, you want to go back to Walmart as a greeter or go back to work? No, you don't. But all of a sudden, your whole portfolio drops by 30%. You can't take out the amount you need for income. So that's why we talk, and that's why Tessa and I and our team all talk about this quite a bit, because you want to start, and it does not have to be at retirement age. It can be before this, by the way. Start taking some of the risk off the table. Start creating that guaranteed income through other strategies, because that's what's going to remove a lot of that stress and fear and worry that people have in retirement. It's just crazy to me. It's like, so people are not worried about not working. They're worried about the money side of not working. And that sucks. So, yeah, I love this right there. Great hat.
Thank you.
It is a great hat.
Yes.
Thank you.
And then, so Matt says, yeah, thank you. I'll give you a call. My kids are young. So that's awesome. So yeah, so if your kids are young, get them started just like Linus is doing, just like we're all doing. He said, I started what Chris does with his daughter. That's awesome. Chris has quite a few videos on what he does for her, but looking to start there soon. But yes, looking at generational. Thank you all again. But yeah, if you ever want to talk to someone about the trust stuff, just let us know. We can, put you in touch with that. And then Craig was referring to, paying out the death benefit to those that are unprepared for it, especially when your kids are young, especially when they're young too, by the way, because especially they're in their early 20s. They don't quite have that full mindset around money probably. So, yep, good question there. Let's see here. What was another question we got? This is a quick one, very quick answer. I have an IUL. Are whole life policies indexed?
No.
No. Simple answer, no. Now, I did give an answer on Wealth Wednesday on this question because we answered a lot, but I always say infinite banking, to have it function as infinite banking, can have a lot of different engines. And IUL is one of those engines. So is a whole life. But the IUL is not the best engine. In fact, it is the wrong engine, in my opinion, but it still is one. Our opinion is it is not the right engine. Whole life is. Whole life has been the best engine for over 150 years for infinite banking. So, and then Chris has a lot of videos on IULs and why we believe that way. But we also have personal track records with IULs. ULs, for me personally, I've had them all, and I will never, ever, ever, ever recommend one of those for infinite banking. And that's from personal experience. So,
and those of us Nelson Nash practitioners, you can't use IULs. That's even in our rule book, so to speak.
yep.
It's basically like code of ethics.
Yes.
You sign it. I think about that a lot. I don't know. I just came up with that right now, but that's what I would call it, Tess, is we've said, hey, we know that it's not in your best interest to use an IUL for banking because it doesn't put you in control. So we actually signed something, even though financially it'd be beneficial for us all to do so. But to do the right thing by you, which is the most important thing, we will not do it because you don't want the risk. You don't want to assume more risk. You want to transfer the risk to the carrier, which you do that through using whole life.
Yeah. And then another great question we got here is, says, what if you have 3 months of hard times and can't fund the policy premium minimums? What happens if it lapses, that kind of stuff? So who will take that one?
First of all, do you have any available cash value? Because that's actually one of the primary reasons whole life was first designed with cash value, was for there to be something to use to pay premiums during a bad time. So that's a possibility. If you're asking this question, I'm guessing you don't have any available. So then it becomes a little bit more, or the options become a bit more narrow. Make sure that you're looking at the actual minimum premium number and not just what you think might be the minimum. So maybe ask the carrier, maybe ask your implementation agent. And then, if you're not able to come up with that, there are a few other options. But most of them are going to involve, irreversible changes to where, you're not going to be able to fund the policy in the future either. Or maybe you're going to try to sell the policy entirely. There's not a lot of other options there. But speak with us, speak with the carrier, and find out your options in full.
Yep. Yeah, it's been interesting. So, I mean, when I did I can't remember where I heard this. I don't know, maybe Linus, when I was studied infinite banking really deep years ago, I heard about how when they first created the whole loan provision, it was mainly a way to maintain premiums during low times and then pay them back during the good times so that policies would not lapse. I don't remember where I heard that.
This guy. Well, it was in your studying too, probably, Brian, but I've said it several times on here. Loans started in like 1848 because, again, people didn't have very good financial acumen then either. And so if the breadwinner was unable to pay the premium or lost the job or whatever, you were able to take the cash value and pay the premiums. You can also reduce it down, which Linus talked about. There's different ways. You can change the mode of payment, reduce it down. You can do it different ways to take care of it. So
I remember something about farmers, because farmers have very up and down income, and it's seasonal. And so, they account for that. And it's kind of hard to find the actual proof of that, but I've never been able to find it. I remember I read it somewhere. I just remember it was a long time ago. May have been actually Patrick Donahoe told me about that.
It's interesting. You can go back to old movies and find out where cash value was being used of insurance policies. Yeah. I told this story before where my mother didn't believe me, 35-year financial accountant in the insurance industry, and she didn't believe me. One morning she comes to me and said, I saw a movie from 1957 called The Wrong Man with Henry Fonda and Alfred Hitchcock. They got a loan on the cash value of their policy. Is that what you're talking about?
Been around a while. That's pretty cool.
She doesn't believe me, but Alfred Hitchcock and Henry Fonda, they know it all.
Yeah, if you want to nerd out on historical things, we wouldn't be necessary if it wasn't for TAMRA and it wasn't for the law in 1988 that changed how you could actually structure whole life. Otherwise, you'd probably be like the Wild West. You could put as much in as you want. You could structure it how you wanted, and it wouldn't matter because it wouldn't ever look like an investment. So now, because of that, we get to help all of you figure it out. And that's why Nelson wrote the book, because of that law helped change everything. And that's not been that long, right? So before this, like when you're talking about the Rockefeller method, when you're talking about what the Rothschilds did or Morgan Stanley's, any of the really wealthy families, they're just using whole life. It was regular whole life with a mutual company. So,
well, it's kind of funny, Jason, if you look at the book and look at the illustrations in the book, what is the thing that's missing in every illustration that we see in most of ours nowadays?
Oh, you talking about having no dump-ins on any of them?
Yeah.
Yeah.
They couldn't do them back then. And so the law of 1988 actually eventually made that possible, which makes these policies more, I guess, usable by the average person. So it's kind of cool how it's changed over the last 50 years to where your average person can do this and really overfund it in a way that was never done before. And so a lot of you got to wait 3 years and stuff came from the way they used to be able to do infinite banking versus how you can do it today. Because now you can have cash value in 30 days. Back then it took some time.
Yeah.
You could still have 30 days if you did an annual premium and things of that nature, right?
Correct.
You just wouldn't have as high cash value. And actually, at times, like I'm actually having a call and I'm going to teach about this tomorrow on my webinar, but it's someone who doesn't have a lot of liquidity. They're going full bore. Like if you're an entrepreneur and you're making money and you're putting it back in the business so you can keep growing and scaling, it doesn't matter if you have hundreds of thousands of dollars flowing through your hands if it's all locked up in an asset like real estate. And that's where they're at. They're starting their 4th property. They're expanding their system. His term is expiring. And luckily he has a return of premium term, which you don't see a lot, but he's like, hey, this is ending this month. I need to get some protection in place. And I know when this other facility opens and we have cash flow again, we want to be able to put more into it. So Brian, what are we going to do? We're going to do a flat base. We're going to attach PUAs to it. We're going to cover the death benefit, give him more than he had with the term. And we're going to be able to put in a lot of additional capital later on to grow and accelerate the banking function of it. So again, if you're clear on what you want, we can really help you design something that might, if I showed anybody that illustration, they'd be like, that guy doesn't know what he's doing. That doesn't ever get to an efficiency point, right? That's not a banking policy. That's whole life. What's he doing?
And there's the question. I'll ask this question here. A client asked me here recently, and it was, "Hey Brian, my financial advisor," which right there, everybody's kind of like rolling their eyes a little bit. Well, my financial advisor said this is only for the ultra rich or the wealthy. Which coming from a financial advisor saying that just blows me. That's so frustrating. So I'll kind of give the answer that I gave to this person, and then I want to hear from everybody else here. So there's multiple ways to answer this one. So one answer I gave was this. Your financial advisor probably does not know how these things work today, because most of them don't. And back in the day, I'm talking like 50 years ago, you couldn't do these dump-ins. So could you, if you were a person making, $75,000 per year, $60,000 per year, did it make sense to do infinite banking if you couldn't do a large dump-in and only your maximum premium was like maybe $500 per month? That's going to be a very slow growing policy versus a wealthy person could put in $50,000 per month, which that's going to be a very fast growing policy. So what a lot of advisors don't realize is specially designed infinite banking can involve something like a term rider that allows that person to put in $500 per month and a $40,000 lump sum at the beginning. So all of a sudden you got cash value within 30 days, a large amount, but you're not having to stick with this huge premium that is just draining your funds. So that's not something that has always existed with infinite banking, but it does exist today. So it makes it a lot more attractive to people that have some savings, but not like this, $500,000 of cash flow per year. So that's one answer I gave. Anybody else want to take that one?
That was good. You covered it.
Well, there's another answer I give to this one though too. There's another answer I give. And this is the one that I've talked to actually some billionaires about this, and that's where my light bulb went off when I talked to them. And so I'll give the answer to this one. So, what did not exist 40 years ago, 30 years ago, 50 years ago?
Universal life.
That's true, but no. But that's a great answer though. I like that one. Social media. So what didn't exist was the knowledge base that you can access now on your phone to learn how this thing works. It was very hard to learn about infinite banking 30, 40, 50 years ago because the knowledge was not out there. The only way to get it was to come across, if you're lucky enough, someone who understands how this works. But your traditional financial planners did not know this back then. But guess who did know about it? Very, very wealthy financial advisors that only their clients are the ultra rich. Their focus is very different than the average planner because they're paid a retainer to give the best advice to those wealthy people And guess what they know about? They know about these kind of very unique strategies. And so they would have their wealthy clients do these. That's where the whole only for the rich came from, is because they have a different set of advisors than the average person back then. But today, because of YouTube and social media, that has changed the game. So now people that are on this call right now can learn about this as they are right now and take action on it. So that's kind of my opinion. And I was talking to some advisors or these wealthy individuals, one of the guys on the show Shark Tank, and they were saying that, yeah, our advisors do this for us. That's what they're telling me. And I'm like, oh, okay. And then I was in a very, very high level mastermind, in which this Shark was one of the members in the mastermind. And there's these advisors in there that are very high end advisors, and they all knew infinite banking. Every single one. And so I was like, okay, the wealthy had access to a different set of knowledge than the average person. So that's my kind of opinion on that one. Like how did Nelson Nash learn about infinite banking?
It wasn't his because his granddaughter got sick.
No, he was from my understanding, no, I don't know. Can't speak for Nelson, and I don't know the whole story from reading the books and everything. It was because he was a life insurance agent. I mean, like, he was an agent for years and years and years. And then when he had everything kind of happen, he started praying and thinking, like, what could I do? Like, how do I get out of this mess? Because he got over leveraged. He got over leveraged in real estate. Like Tess said, his granddaughter had cancer. He ended up also having his house broken into. So he had all these things happen. He was like, I need a solution. And looking for a solution, he realized his long-term thinking. He had been an Austrian economist since the 50s. Right. So he had been following Austrian economics since the early 50s, Brian. And then he put the pieces together and started using it for cash value.
Yeah. So he didn't invent it, but he literally figured it out by just wade into that whole world, which is very hard to do. I mean, yeah, I mean, we're very fortunate that he did that, because we might not know it as we know it today if he hadn't done that. But I remember that's kind of the story I kind of remember too, that he was in the industry, didn't know about it while in the industry, started looking at these different products and saying, okay, why is this function this way? Why is it good to do this? Wait, you can do this. And then I don't remember if we ever talked about the Rockefellers, but the Rockefellers have been doing it for a long time.
They're doing it a lot differently. They're doing it with the trust structure, and they're doing it where, like, with the stipulations, right? Okay, like, this is how Nelson started doing it. Like, okay, like David Stern talks about it all the time, right? He said, hey, okay, we got a new grandkid, we need a policy. Like, oh, hey, someone got married, welcome to the family, new policy. It's like, it wasn't a choice. It was like, as soon as they were an insurable interest in the family, they were insured, because that prevents things. Like, if you have a ding dong in the family, and we all do, right? I've heard people say that, I like it, so I stole it. When they aren't someone that you would trust with a policy loan, or they don't pay it back, well, guess what? They're going to die someday, and they're going to replenish the whole thing they didn't pay back. And that's what the Rockefeller saw. They set up the structure that was a container that was always replenished, and it's not replenished; it's actually multiplied.
Yeah, I was gonna say
that's how you flourish it, because I was looking at Connors today, because someone was asking me, it was a 71-year-old was saying, oh, I wish I knew about this then. I'm like, well, the younger you are, I started Connor a few years ago. He's 12 now, right? So I started him at 8. And by the time he's 90, it's got millions and millions of dollars of death benefit already. And we put in a fraction of it. It's like a 10x multiple of whatever we put into it is what comes out the other end, because of the uninterrupted compound interest. So back to what you were saying earlier, Brian, just to kind of wrap up a thought that I was having about it. It's not always even the design. It is the volume of paid up additions that you're putting in, because you can have the same design at 500 a month, 5,000 a month, 50,000 a month, right? It is the volume of paid up additions that really accelerates the growth with the exact same design. That's why some people say, hey, a 1090 is awesome. Sure. If you're putting $100,000 in a year and you have a $10,000 base, not when you're putting in $100 a month or $200 a month. It's a volume equation with how it all lines up and works.
Yep. Yeah, I agree with that one as well. Yeah, because the Rockefellers and stuff, a lot of it was like the multiple method, generational wealth, that kind of stuff, and having the liquidity and the protection, blah 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 blah. Yeah, I mean, one of my old acquaintances, buddy of mine, I mean, he's putting in, I think, 200,000 a month into policies and multiple policies, and and he talks about that concept. But I mean, he has a different set of advisors. Like, and he didn't even know that I did it. Actually, by the way, it's kind of funny. He didn't even know that I did this because I don't talk about it. But he was talking about to one of his mastermind groups, and this mastermind group has a lot of business owners and very high net worth individuals. And sure enough, hey, who's doing this? Ding, ding. Hands go up.
I'm pretty certain. I mean, like you said, people that are getting sound financial advice are going to have whole life as part of their family strategy, just whole life. I'm pretty sure Nelson Nash coined infinite banking. I mean, that's why they have a trademark, right? That's why if you're trying to use it in a way that Nelson wasn't teaching it, you're going to hear from the institute.
Yeah.
So I don't think the term was even out there before Nelson wrote his book. So
no, I don't think it was. No.
Yeah, the way I understand it, when Nelson fell on the the hard financial times, he already had multiple whole life policies, just kind of how people would buy term policies nowadays is like, hey, I need protection, so we get a life insurance policy. Well, back in the day, term wasn't really a thing. Universal life definitely wasn't a thing. And so in Nelson's time, he had bought a life insurance policy, just basic whole life, as he had need for protection or had some extra money here and there, just whatever. And they were all whole life. So when he comes on those hard financial times and God shows him, wait, you have liquidity over here. And I can take a policy loan and I can basically begin to refinance some of all this bad bank debt whose rates had shot way up because they had the control to do that. So then from that point forward, he's like, wait, I got to start putting more money into policies so I can, and he's thinking long term, so I can start refinancing all this bank debt into policy loans where I have the control. And so it took him a long time. He's buying more policies as much as he can, and it takes a long time. So that's what that looked like. and then something I find interesting, kind of a different vein. Well, when did the MEC rules come into play, Tamara? Was that
88?
88?
Yeah, 1988. Yep.
So before then, it was pretty common for parents to buy a single pay whole life insurance policy on kids. So, and I've seen plenty of these where there's only a one-time premium payment up front, no more premiums due from there. So say, for example, $500 one time buys $5,000 on a whole life death benefit. And then it grows a little bit from there with dividends if it's with a mutual company. But nowadays, that type of policy is immediately a MEC. So people tend to avoid those because the growth, if accessed above cost basis, would be taxable. So things are a lot different now, but back then, that was very common. I saw one the other day that was, what was it? 50 years old, I think? Yeah, 50 years old, 50-year-old policy that had been a single pay that the parents bought when she was like 13 for a $5,000 death benefit. I was like, wow, this is cool.
What did it have in it? What did that look like? I've never seen one of those.
Initially a $5,000 death benefit. I don't know what the premium was initially. Just based on today's, single pay rates, I would think it might have been, $500 to $700, somewhere in there. It could have been as much as $1,000, but cash. Well, okay. So the death benefit has now grown to, I think, closer to 10 grand, maybe 9,500, something like that. Cash value. Was it 4,500, Tess? Do you remember?
I thought that sounds about right.
Yeah. That would sound about right, because if you look at the scales, right, you don't ever have cash equal the death benefit until the last year. So if it's a 100-year contract or 121. So if she's 50 years in it, it's probably like halfway to the net at risk, right? So that would make sense. So that's interesting. Okay.
Yeah, it's cool. It's with a mutual company that is even non-direct recognition. So she definitely wants to keep that and use it. So that's awesome. It's not a company we typically use nowadays for infinite banking, but it's perfect now that with her already having it.
Awesome. That's cool.
Yeah.
Well, awesome, everybody. Looks like we made it to the end. We went to full time again.
And Andrew, good to see you on here. He was in Atlanta.
Really?
Yeah.
Well, cool. Well, awesome, everybody. With that, we will let you go and tune in next week for another Ask Me Anything and bring those questions. But with that, take everybody and hope to look.
Happy 250th 4th of July.
That's it.
Happy 4th. Stay safe. All that.
Go USA.